Welcome to the Three Questions webcast series. I'm Wayne Baxter, Executive Director with One Capital Management. At One Capital Management, we develop and implement strategies that enable our clients to grow, protect, and ultimately distribute their wealth. And we do that by offering investment wealth management services. Thank you for taking time to check us out. My clients are often referred to as cross-border clients. Now, why is that? Well, it's because they're either U.S. or Canadian residents who wish to invest in U.S. and or Canadian dollar-denominated securities like stocks, bonds, and ETFs. Our process for advising our clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. The goal of the Three Questions webcast is to educate and inform you about some of the financial issues that you may encounter, and in doing so, introduce you to some of the experts that may be able to assist you. On this edition, we're going to talk about cross-border tax planning through the lens of a United States-based transfer pricing economist who provides services to Canadian business owners. On this edition of the Three Questions webcast, we'll be asking the three questions Canadian business owners should ask about transfer pricing before establishing operations in the United States. Joining me from Detroit, Michigan is Alex Martin. Alex is with the firm KBKG, a national tax specialty firm with offices across the United States. Alex has been a pricing transfer economist for over 25 years, working in the U.S. and overseas. Hi, Alex. Thank you for taking time to join us today. I really appreciate it. Before we get into the three questions, why don't you take a couple of minutes to talk about the expertise and services that KBKG provides?
Sure. KBKG is a nationwide U.S. tax specialty firm, value-added taxes. We help clients where they're doing research and development and get tax credits for that type of activity. Cost segregation, which helps companies depreciate their assets in a tax-efficient manner. We also work in the areas of green energy, green building. We also have been helping out a lot of clients in the employee retention tax credit program, which has been very helpful for those companies affected by the pandemic.
And your clients are literally all across the United States and even across the world.
Exactly. We certainly, our niche has always been in the US, but we work with both US owned or foreign owned, internationally owned companies.
Which is a perfect reason why we wanted to have you join us today. So today we're going to ask the three questions a Canadian business owner, and you being in Detroit, just across the river from beautiful Windsor, Ontario. We're going to ask the three questions Canadian business owners should ask about transfer pricing before establishing business operations in the United States. Now, the first question I think is an obvious question, which is what is transfer pricing and why is it so important?
Okay, great. And Wayne, thank you for the kind introduction there. Transfers pricing is all about helping companies figure out, make sure every company is paying the right amount of tax in every country where they operate. And so effectively any company that has cross-border operations, so let's say a Canadian company that is selling products in the US, well, transfer prices relate to the prices charged between entities. So for example, if I have a Canadian parent company that's selling products over to a US subsidiary, if they charge too high a price, the IRS is unhappy. Why? They're not paying their fair share of tax. Conversely, if the Canadian company is charging too low a price for the inventory that's coming across, the Canadian Revenue Authority is unhappy. So effectively, you've got two tax authorities that want to make sure that multinational companies are paying their fair share of tax. So this gets to be quite a contentious issue from time to time because, well, depending on how you see the company can drive what your expectations are for the profits generated. And just maybe as an addition there, it's not just inventory, it's services, it's royalties, it's loans, what have you. If there's a cross-border element to a company's transactions, there's a transfer pricing issue in play.
Very interesting. So I guess the next question is the obvious question. You mentioned the IRS. How much tax does the IRS expect a Canadian-owned business with U.S. subsidiaries pay them? Is there sort of any kind of formula or expectation?
Unfortunately, I'm going to have to take the economist approach and say it depends. But there are some good rules of thumb that you can apply here that can make life a lot easier. Um, Quite often, what we'll talk to about Canadian entrepreneurs setting up an operation in the U.S. is, realistically, the IRS is going to want to see some level of profit in the U.S. subsidiary, um, at least within the first 2 or 3 years. Now, what that level of profit should be really does depend on the industry. Conversely, from a Canadian point of view, if you leave all of your profit in the US, they're going to be upset about that. So it is quite a bit of a balancing act. All that being said, what I strongly suggest is to focus on what your cash flow needs are in from a US or Canadian point of view. Do you need to have more cash in the US so you can invest in plans, hire new people, invest in a new marketing plan or program? Alternatively, do you need to have more cash in Canada because you're doing R&D, you're trying to expand your manufacturing facilities to keep up with demand, what have you? So there are a couple different things that come to apply here. The general rule of thumb, hey, let's just make sure that we've got at least some level of profit in the US, but we do have some flexibility there in trying to make sure cash gets to the right spot. And that also drives your global effective tax rate too.
So I can obviously see the role that you would play. You're almost acting like an internal auditor to basically understand the spending requirements in the U.S. and in Canada, and that way that's a part of the process that you help to determine the appropriate amount of tax that the IRS is being paid.
Exactly. And again, it's a balancing act, but if we can get a good story going, understand how your business operates, and be able to explain how your business operates on both sides of the border, you're going to be better off than 90% of the companies out there.
So I think the next obvious question to ask, now that you've mentioned this one, is almost a reverse or conversely, how much tax does the CRA, otherwise known as the Canada Revenue Agency, expect a Canadian-owned business with a U.S. subsidiary pay? Is there the variables or the calculations different than what you would provide the IRS, or is it basically the same story told to do different tax entities?
I'm a big believer in telling the same story to both sides of the border. So, but effectively, the CRA is going to look at a U.S. subsidiary and say, well, hey, is that U.S. company earning far more profit than they should be, and should be depend if it's an automotive industry or if it's a pharmaceutical industry company. But what I do say there is, if you're getting 50, 75, 90% of your profits over in Canada, I'm sorry, in the US, you're probably going to create some heartburn on the Canadian tax authority side. What do I see normally? Hey, is the parent company charging for service fees? Is the parent company charging for royalties? Um, could there be some kind of changes that need to be in place for um, payment terms? All these things are important to juggle and think through, but I think there is a good systematic way to approach these things because, well, frankly, we just want to make sure, to the extent possible, make sure both companies are both sides of the border are reasonably happy with things. And again, let's just stay out of the tax audit, and let's also make sure that we're getting cash where it needs to be in the short term.
So basically, you're playing the role of just basically peacemaker between the company and the IRS, and the company and the Canada Revenue Agency.
That can be the case, and it's unfortunate that sometimes actually the governments fight over how much profit, whether it should be in Canada or the US. So yeah, again, it's a contentious issue, and so you need to have some.
But the contentious issue is actually between the two tax agencies, not actually the business.
Exactly. So you don't want to be in a situation where both the Canadian Revenue Authority and the IRS are saying, well, there's $100 in profit and we both want 75 each. You're that's a difficult.
That would be a little bit of a challenge. Well, I must admit, I know this is a three questions webcast, but I actually do, Alex. I'm going to break the mold here a little bit. I got a couple of additional questions. I guess the first one I got to ask is about, your work and how it relates to cross-border mergers and acquisitions or M&A work. How much is your transfer pricing services related to, a Canadian business looking to either be purchased or purchase a U.S. entity or vice versa? Does your work get involved in much of that?
It certainly does. And the reason being is that since we do have two tax authorities looking at the same transaction, it's quite often the most contentious or the biggest tax issue that a company you're acquiring or merging with may have. And for a long, long time, when I first started, it was only the very largest companies that were audited for transfer pricing. That threshold has come far down over time. So what I'll find is that sometimes companies and even sometimes their advisors won't necessarily have a good handle on what the transfer pricing should be, or if there are any red flags that may come up in an M&A transaction. Again, sometimes it's very helpful just to have a sanity check of, hey, how is the IRS looking at this company? Would they be comfortable with the level of profit here? And conversely, from the Canadian side, hey, is there too much, too little, not enough, or are we in the golden Goldilocks spot here? It all makes a big difference.
You know, I always am a big fan of entrepreneurs, Canadian or American. So just to sort of wrap up our discussion here, from your point of view, what advice would you have for a Canadian entrepreneur looking to expand their business into the U.S.? So there was sort of like a call to action for them. What would that be?
I think one thing that's when you're establishing a subsidiary in the US, I think it's always helpful to have excellent accountants who are experienced with working with Canadian US CPAs. It saves so much heartburn over the long term. The second thing, and at least just from a transfer pricing perspective, I think it's very helpful to have an intercompany contract between Canada and the US. It outlines roles and responsibilities, um, doing the R&D, who owns the intellectual property, what services are rendered across border. Always really helpful, and it helps you get a handle on, well, what do the tax authorities think about? And whether you do some kind of transfer pricing study or benchmarking, hey, maybe that's done in the first year, maybe not, but at least you're well on your way trying to get ahead of, well, where 90% of those companies um, may be missing the boat, but really can help facilitate growth of the business over the long haul.
On the timing side of all this, just say, I'm the entrepreneur and I'm thinking of expanding my operation to the United States. From a timeline perspective, Alex, how far in advance before I commit to making that move should I be talking to you?
Um, let's start right off the bat. I mean, at the end of the day, if you've got some ideas on, hey, I want to sell through Amazon. Hey, I want to really need to set up a subsidiary. I need to import some products from China. Let's just talk through things. I mean, there may be some very straightforward workarounds that can make life easier over the long haul. And we work with CPAs and attorneys and other professional advisors from coast to coast. So we certainly be happy to put you in touch with the
So,
right
so
person
I,
at the
I
right
guess
time.
I guess you could say that the theory is act or be acted upon. So better to get out in front of this as far as you can.
Exactly.
Okay, so we've included your contact information here on the screen, but for someone who's looking for your assistance, what is the best way for them to reach you?
Sure. Certainly, email's the easiest way to get hold of me. Alexander or Alex.Martin at Kid Boy, Kid Girls. People sometimes get the acronyms wrong, but it's kbkg.com. We're grateful we have 250, 300 people coast to coast and transfer pricing in other areas. So yeah, we're grateful to be a sounding board and yeah, help facilitate growth worldwide. It's why I've been involved in this, and always happy to pass along any advice or suggestions that can make life easier over the long haul.
Well, I'm really pleased that we connected, Alex. I want to thank you for making time for joining us today. Alex Martin is with KBKG. He joined us from Detroit, Michigan, and he's a transfer pricing economist and KBKG is a national specialty tax firm with offices across the U.S.
Wayne, thanks so much for inviting me. I'm grateful for the opportunity and thank you again for the invitation.
I look forward to bringing you the 3 Questions webcast, and I hope you find them educational and informative. Please consider liking this video and to subscribing to our YouTube channel. And to receive a notification of when our latest webcasts have been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meetwithwayne. Thank you and see you soon.